Welcome back, everyone, to a brand new episode of the Crypto and Muay Thai podcast. I'm your host, Chris Brookins. I am super excited to welcome our guest today, Daniel Kim. Daniel's the head of revenue at SFOX, which is a liquidity provider, or dare I say, my prime broker for the fund that I manage, Valley and Dara Digital Assets, based out of San Francisco. Daniel is a great guy. I've known him for a good bit. I'm super excited to have him on the podcast. How you doing today, Daniel?
Doing well, Chris. I'm super excited as well. Saw your other podcast as well, so really ecstatic to be on.
Hopefully we can continue to get it better, and better. So for some of the listeners that might not know who you are, or maybe some of your background, just give us like a quick 2-minute overview of like your background, and then also like a natural sort of launching pad into how you went down the rabbit hole that is cryptocurrency ecosystem or digital asset ecosystem.
Yeah, sure. So I would say like most folks, I actually started in capital markets, started my career in State Street and BNP, spent about a little over a decade there on the interest rate derivative side. But during that time, I was there during the recession of 07, 08, kind of saw a lot of things change. And in my view, I was like, all right, like I've been like, I was seeing a lot of things going on where I was kind of questioning the financial market. And coincidentally, during that time, I was also working on a side startup, completely outside of crypto. It was an e-commerce site. But one of the biggest things was, it was actually the payment side of things where, when there are chargebacks, ACH and credit cards, there's a lot of chargeback issues. So I was looking for another solution. And that's actually kind of how I came about to crypto Bitcoin. Kind of realized that, Bitcoin is immutable. It can't be changed, can't be reversed. Sound like a good solution. So I kind of went through that rabbit hole. And when I was diving more into it, I was like, wait a minute, forget the e-commerce. Bitcoin is a huge new thing. Financial market's going to completely change. And looking at my background, I was like, man, this makes complete sense. Now, how do I get into this space, right? Because I remember right when I found Bitcoin, I looked at what companies are out there. Coinbase was out there. I'm like, all right, let me look at Coinbase. I don't have an engineering background. Everyone was hiring engineers. I'm like, crap. Like how the hell do I get involved? So I just kept searching, started talking to people, got involved, and then coincidentally, one of my close buddies, Bobby Cho, who was the ex-head of Cumberland and started at Genesis as well, he was moving from second market to Paxos IPIT, and he asked me, he was like, hey man, I'm going to this company. Do you want to join me? Because I know you talk Bitcoin, you like Bitcoin, you come from the capital markets background, it makes sense. He sent me a Craigslist ad saying, hey, in the job description, I was like, dude, this is sketchy. But I met the guys, they were creating the first trust company in crypto, moving the headquarters from Singapore to New York. They got the New York DFS trust license, becoming that first one in New York. And, help them. So that's how I basically started my career. I came in as the operations side, helping that transition. And then from there, worked with all the institutions. IPIT Paxos started moving away towards focusing on the blockchain side of stuff. And then I moved over to Gemini as the head of sales. And while I was there, my career from that point was, really dealing with institutional clients, right? We were focused on working with hedge funds, banks, and so forth. And at that time, you look at it, and this is around 2015, 2016. And I was looking at the market, and I'm like, man, a lot of people are saying what's blocking crypto adoption is regulation. But at that time, it was actually regulation was a part of it. But if you look at it, it was it's actually infrastructure, man. You want these players to come in, they're not going to want to onboard with all these different crypto exchanges. Market's completely fragmented. Everything is a little bit different. And coming from my background, I was like, wait a minute, this is what a prime broker can do. This is what people need. And it turns out one of my first clients was SFOX. And they were first building out a aggregation platform. And, after that, I came to them and I was like, let's build out a prime brokerage. This is what it makes sense. So in 2017, I joined SFOX, and the idea was, let's be that first prime dealer, make it as simple as possible to provide that secure, easy way into entering the market. Rather than having companies open accounts at all these different exchanges, just integrate with one platform, get access to all these liquidity providers and create that uniform process.
Gotcha. So that's a very robust and logical sort of way that you got involved here, which typically, well, I should say sometimes isn't necessarily the case whenever we're speaking with other guests. So that's actually, it makes complete sense and it's very, very easy to follow. With that, so you're at SFOX and you have the idea to, and I totally agree with you. And even in some capacity today, the infrastructure has gotten so much better, but there's even still a few chasms to jump before you really start getting a lot of those large institutions with multi-billion dollars under management jumping in. So I can only imagine what it must have been like whenever you were really back there at the beginning phase of getting SFOX off the ground. With that being said, you've got the idea. You're like, okay, let's see how we can implement this. What are some of the initial hurdles that you guys had to go through? Because obviously, like life and tech, but also specifically within the digital asset space, nothing really ever goes according to plan usually. And there's always like some kind of like iterative process to where you thought you knew something, but then it didn't actually sort of pan out.
Yeah, no, that's a good question. I mean, look, I think like most people say it's, when we first started off, people were like, oh, like I could build out my own smart routing solution. Like that's like, I have my engineers, I can build it out. But it's easier said than done. Because this is going back to the point where that infrastructure just isn't there. Because if you look at every single exchange has a different API, and every infrastructure is very different. What their rate limits are, what method are they support? Like, are they supporting REST? Are they supporting WebSocket or Fix? And what that implementation is. Everyone has a different implementation, so there's no uniformity in that. And so when we were building it out, the biggest, surprising thing was, there's only the throughput can only be handled so much, right? So we had hundreds of millions of trades go through our platform, but in the beginning, dude, there were so many headaches. Like, you would try to put in a trade and try to put a smart routing order trade across, Kraken, Coinbase, Gemini, and a few others, and half of those orders would get rejected. And it could be either because the price feed was incorrect from their end, there was a lag, or it just got rejected because there was just too much throughput. And so working on those mechanics and making sure, all right, like how do we improve that? How do we work with it? And we could only do so much on our end, so we actually had to spend a lot of time working with each of these liquidity partners and making sure that their feeds to us specifically is as optimal as possible. And today now it's fortunately for us, because we started so early, we built these strong relationships with them, and that pipes and plumbing has been completely cleaned out. And as you've probably seen, that every trade that goes through our platform, it actually happens very seamlessly without any issues. And that's what we'd work towards. It was just so surprising because we didn't think it was going to be that bad in the beginning, but that required our entire team to spend years on fixing that and cleaning those pipes.
Yeah, it's really interesting because I don't have a technical background, much like yourself. I'm a career finance individual in some frame or fashion, and also, had a stint as business development within a high growth startup that was based out of San Francisco, very similar to yourself. Because I didn't have a tech background, I was like, okay, but I know how to sell. So that's kind of how I made my way into that particular space, which I've since used here. The point being is that because I didn't have that, but I heard a lot of these horror stories from maybe some other early stage quant funds that were trying to build out that functionality themselves, but kept, essentially ran into the problems that you were talking about with the different APIs, the call limits, bad connectivity. Sometimes the exchanges would just switch the API without notifying the people, the developers on it, like all these crazy things. So instantly I knew whenever we were standing up, Valley and Darrow, that this was not going to be something that we were going to necessarily want to handle in-house. We were going to try to see if we could delegate it to someone. And then obviously through trials and tribulations and error or trial and error, we ended up at SFOX, which you guys getting there and starting there at the beginning really helped clean out a lot of that work. But we heard a lot of those horror stories at the beginning. With that being said, do you guys find that it's like, is it more money, more problems now that the infrastructure has gotten past, the initial hurdle of issues, or is it, and then it's clear sailing, or is it like, all right, we got past this level, now there's this additional level because maybe the type of investors that are coming into the space now are maybe a little bit more, they demand a little bit higher quality service because they're more sophisticated than typical retails. So how's the state now from your particular perspective, given you're there at the beginning, work through some of the hard stuff? Is it kind of like greener pastures because you've gotten through those hard times, or is it just, the next layer of issues that are inevitable as the space kind of like grows and matures?
Yeah, that's a good question. So I think it's different types of issues. What I will say is like it has become greener pastures in terms of like integration and so forth, because we've been fortunate, like, again, like we've been very fortunate. We started early, and to be honest, like there were in the early days from 15, 16. In fact, there were various different traditional investors already involved. People may not realize this, but like family offices, prop shops, they were actually already testing the waters back in the day, right? It's just got more adopted recently in the past years. But back in the day, privately, there were all these funds and active traders involved in the market. You did see some of the major prop shops already trading and testing the waters. And fortunately for us, given where we are at the time, since we started in 2015, we actually saw, we had those type of clients, and we saw the different strategies and needs from what they wanted, right? And they put in the throughput into our system. And so because of that, of what we've experienced, we pretty much were able to meet the demands and develop our systems to address that. So when I say the pasture got a little greener, is because we work with all these exchanges to make sure that, that throughput and everything that those guys required was met. And because of that, over time, when the exchanges started seeing more adoption on their end, they started improving their infrastructure as well. And that's ultimately helped us. So in that end, for us, it's been a lot easier. If anything, now it's just that we're seeing more improvements on, we're just seeing more improvements on our API through the exchanges and other partners that we work with. In fact, it becomes a little bit easier because things are starting to get a little bit more uniformed or more expected that, these guys have WebSockets, these guys have fixed, and there are no rate limits, or it's limited to the point that it can be used. So that's basically what we've been seeing, and it's becoming a lot easier on our side. But the only reason why is because we've been able to develop that core issue, right? What I would say is when we've seen other people do the same, they're encountering some of these similar issues that we've dealt with in the past, and that's primarily because they likely just didn't have that same experience that we went through. So you need to unfortunately go through those pains, and then it gets improved. Now, are there new issues that do arise from this? Yeah, there are, right? Because, you do see that clients want, they're like clients have different needs in terms of different types of order types, or they need something that's a little bit more, they want faster, they want to be able to co-locate or whatnot. And so I think that doesn't make it more difficult. It just adds new features that maybe we didn't expect.
Gotcha. That makes total sense. You mentioned it a couple times, but I think the topic of liquidity is often not often talked about and not often understood nearly enough. So I think the general premise of a prime broker, for anyone that doesn't necessarily know what that is, in addition to solving all the headaches of that might come from a technological standpoint, where you don't need the engineering talent to be able to plug into, let's just say, a half a dozen different exchanges with different APIs and different rate limits and blah, 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 blah. It's also, you now have the ability to pull liquidity together so that you can move around larger block sizes, maybe get more efficient prices in terms of trade fees, execution prices, less slippage, all those types of things, which I think a lot of times is talked about, but isn't necessarily understood fully. So given that's kind of like the business that you guys are in, I would love to just like kind of get your take on that, and also hear it through your own words as well, because I think it's very important for any listeners to like really have a full appreciation for it, given it is still kind of a little bit of an issue within this market, but gradually being solved more and more with participants like yourself with SFOX.
Yeah, definitely. And it's actually really funny. It's, you would think, and it's a good point, right? Like liquidity isn't actually understood, but honestly, I would have expected that more sophisticated funds would have realized what liquidity is, but surprisingly, sadly, a lot of people don't really understand what liquidity is, and it's kind of surprising. I mean, because some people just may look at in one factor, but liquidity encompasses a number of factors, right? It's not just price, it's not just depth. People just may look at volume or whatnot, but I'll go into all of that, right? So, to me, liquidity, there's a number of factors. It's a trading volume, it's the spread, it's the order book depth. And when depth, I mean by what's the slippage, right? If you buy 10 Bitcoins, you're not going to just get whatever the top of the price is. It's what that net price is going down in 10 Bitcoins. The market activity. So a lot of those components matter. Now, what we do see in the space today, it's, some people may look at liquidity, all they're focusing on is trading volume per exchange, which is completely inaccurate, right? Because honestly, if you're one trader, you can trade, zero point 0.1 Bitcoin, constantly turning that over to $20 million, right? If you're running some algorithm, you could trade that. So that doesn't represent any type of liquidity. All it does represent, a portion of it is that there is a lot of activity going on. So if you were placing a limit order or a maker order, the likelihood of your order getting filled quicker is higher than an exchange that had lower volume, because what that volume does represent is that there's a lot of activity going on to an exchange. The second piece is the spread, right? So the tighter the spread, the better the market is, because that allows then that there's more competitiveness on the exchange. When you're looking at exchange, someone may say, oh, these guys have the best price, these guys have the worst price. And that spread really does matter. So when you look across exchanges, you can see that there are some exchanges that have a penny wide spread versus other exchanges that have a $12 spread. And that's a part to think about, because when people look at exchanges, they're like, oh, but this exchange has this exchange has the best price, and they have a penny spread. But that also means that they don't have that they have the best selling price, and they won't have the best buying price, right? And so I think that's people miss that idea. And then the other factor is again, going back to order book depth. If you are going to trade, 10 Bitcoins, 20 Bitcoins, you can't just look at the top of the book, and you can't just look at the spread. If you're going to be one directional, you got to really take in consideration, buying that 10 Bitcoins, how deep is that going to go into your order book, and what that price is going to be, right? Because that top price may only be representing 0.1 Bitcoin or like $100 or whatever. And then for you to fill that 10 Bitcoin or $1 million, it's going to go deeper, and that actual cost, it's going to be a net cost that's actually a lot less than you expect. The other side of it, lastly, is then it's the trading fees. People always actually forget that there are trading fees associated with any exchange, and you're looking at, like, I'm going to get I could see that this exchange has the best price, but then you're forgetting that there's an associated trading fee with that. So when we talk to clients, when we talk to retail investors, or all across all types of users, we try to explain to them, making it as transparent as possible. Like, look, this is what the market is, and part of that is the aggregation. You could see the individual exchanges where saying what one price would get. But if you aggregate everything, you can naturally see a tighter spread, but also improvement in liquidity in terms of order book depth.
Gotcha. I think all those points are so vital for anyone that's looking to participate. So obviously, more sophisticated, the investor, they need to understand it, but also the retail investor too, because just like you said, it's a common misunderstood situation, is that slippage and trading fees matter, especially given this sort of notion, which isn't necessarily endemic solely to the digital asset space, but also all financial markets, is that it's sort of like a DIY type thing where, you know, in no other profession where would you be able to go grab a book off the shelf and think like, hey, I can do it myself, especially in terms of day trading, actively trading and hitting home runs, whether that's, you know, a 1x, a 2x, a 5x type return. You wouldn't do that from a doctor perspective. You wouldn't do that from a car mechanic perspective or anything like
Right.
that. So financial markets are very much a DIY, especially in terms of a market that is still very much caters to the retail investor. So I think it's very critical to understand some of those plumbing issues, not just from a liquidity perspective, but also like what you're talking about from a fee perspective as well. With that being said, one of the things that kept coming back to me, so I guess it's like a two-part question, is one of the things that kept coming back to me is the thought whenever I had a conversation with John Vincent from Wacom Capital, is he was describing liquidity in this market like an accordion, to where it's like there, but if there's any sort of like oh shit moment, it quickly evaporates. So how have you guys seen that or put you know, things in place to address that for your clients, whatever it may be? And then on top of that, what are some of the stories or experiences that you had with this most recent flash crash
Yeah.
from March 12th and March 13th?
Well, that's the beauty of the prime brokerage model, right? It's because you're completely right. When you're looking at certain exchanges or OTC providers, when these market movements happen, you see that accordion effect, right? And in that sense, like that's the biggest thing. Like when those markets happen, when those events happen, you can't get in or out of position. You're kind of pretty much screwed, right? Um, and so for us, like that was probably one of the more important things that we wanted to solve when we created this business. We saw that at the beginning because flash crashes were happening so way more often than before than it is today. And what the prime brokerage model, the aggregation model, does solve is that when you see the accordions, it doesn't happen across all the exchanges or OTC providers. It happens to maybe one or two of the main ones that happen, and it changes from time to time. So by us aggregating everything, that actually reduced. Well, we saw that there was a big improvement because when that does happen, say it's exchange A, when exchanges A liquidity basically goes away, you still have exchange B, C, and D to back them up, and that created a lot of value because when in those markets, in this market today, you have to accept that is a risk that's there today, right? That there are exchanges and OTC providers that when markets move, it will change actively. Now and that's the reason why you need to have all these aggregated liquidity providers, because it's not going to happen to all of them, but once you remove one, you'll still have backups to trade with. What's interesting though is that we do see this more often happening to OTC providers, and for good reason, right? Because OTC providers are taking principal risk, and so when markets are acting up, they need to secure themselves and hedge themselves, right? So they'll make sure that when those markets happen, they're going to widen out their spreads. So what you usually see in our book is that during non-volatile times, OTC providers will always be at the top of the book, and which makes sense because they are competitive, they will compete for flow, and they will price themselves as best as possible. However, when price markets are moving very quickly and there's a lot of activity going on, there's a flash crash, they immediately expand out and you won't even see them in the book. And for us, that's because we're given reason, right? Because they realize they're not going to take a big position and then get stuck with it. That their whole point is being able to know when I can take a position and how I can easily get out of it. And so that's basically what we saw. So when the flash crashes actually happened for us, like speaking specifically, that was probably one of our best days because we didn't go down at all. We were operating constantly because we did have some exchanges go down, but all the other liquidity providers that we have, which are we have over 12, were still operating, and our spreads were still tight. Our spreads were still there. The exchanges were still operating. So that's what really showed the value of our system.
That's great to hear. I mean, we were trading algorithmically through that particular day, so we didn't experience any issues from our side. with SoFox as well, but I wasn't sure. Obviously, there's a difference between like kind of what you're seeing from our side, also from what you're seeing from your end as well, given so many exchanges, particularly derivatives exchanges, were having to essentially shut down the engine given the haywire that was occurring. So whenever I hear that systems that you have put in place to solve this particular issue still functions even in very atypical scenarios, 3, 4, 5 sigma events, maybe like two to three sigma events in crypto. That's still very, very good to hear. And it's like, that's how you guys are fulfilling on that initial value prop of where you saw how to take the space moving forward with liquidity. So that's really, really interesting.
Yeah, it's like it's kind of scary to be honest, though, right? It's like you think about it, like and like yeah, it is very interesting that we're doing this, and that's the goal. But it's scary to know that the markets aren't as liquid as people like. The markets are liquid when times are good and markets aren't volatile. But then when volatility does happen a lot, and in our market it happens often. It can get scary because if you're trading on one single exchange, dude, you could be locked in and not have access to your account for God knows how long, right? And if you don't have, like, our markets move fast. If you don't have, if the exchange goes down, you're pretty much screwed. So like that's something that people I hope people consider and realize that like there is that risk. It's not just people always worry about the security of their coins, but you also got to realize the security of when can you actually trade, and I think that's something that people need to start considering.
Got you. So that sort of line of logic takes me to somewhere that I wasn't originally thinking, but I guess technically competitors for you guys, although I don't know if there's a full prime brokerage for the DeFi space. So for those that don't know, this is essentially the year of DeFi or decentralized finance for long. And so essentially all that means is the individual, the trader, or the fund behind it they self-custodian their own fund account. So the exchange would never necessarily come into control or touch the client's funds. With that being said, it's very good, or in theory, it's very good from a security standpoint because exchanges have been known to be hacked within this particular space. But given the volume on it is very, very nascent, which doesn't equate to liquidity, as we just learned talking to Daniel, it's been a little bit slow in attracting more and more users to it and more volume and more liquidity. With that being said, I know there's a lot of DEX aggregators, so decentralized exchange aggregators that have cropped up this year and have since kind of gotten into very competitive competition with one another. Do you look at those as competition, something that can realistically take market share away from companies like yours? Or do you look at it almost from the next thing to look at to potentially disrupt yourselves, kind of how Coinbase is looking at it whenever they purchase Paradex? So they're the biggest, or one of the biggest centralized exchanges, but they can kind of see it given the ethos, which is towards decentralization, and they're gradually nibbling more and more within the decentralized finance space.
Yeah, I mean, so to be honest, we don't see DEX, decentralized exchanges, as a competitor. And I think it's going to be a added value service, right? Because there are different type of clients that are going to be used DEXs, and I'm all for DEXs. I think decentralized exchanges, decentralized environment is something that's needed, and I'm very how it's going to work out to be, right? Because with the capabilities of what it can do, it's quite amazing. However, there are some drawbacks, right? Like I would say right now, the people who are mainly using decentralized exchanges aren't necessarily, like, there are some that are trying to actively trade on it, but these guys are more individual traders, retail traders, experiencing and trying to play with it. But institutions, you really got to ask the question, like, who is the decentralized exchanges for, and who will use it, right? Right now, I see it as individuals who want to be decentralized, don't have their own bank accounts, want to have control of the funds. And that's going to be more on the individual retail level. Will institutions get involved? I think eventually, when the user experience and the infrastructure improves on that end. But for now, I think it's more of a complementary service where, we're keeping a close eye on it. We love what they're doing. And, hopefully it's going to be something that we do get involved with. Because I think if they still have I think there just needs to be, there's still a couple of years out, right? Because you've seen, like any new product that comes out there, there's going to be some issues. We've seen some hacks with it. And, same thing when centralized exchanges first came out, right? Think about when we first launched, like when crypto first launched, with all the exchanges, Bitstamp had a hack, a few other exchanges had a hack. Those are growing pains. And that's something that DeFi and decentralized exchanges are going to need to go through. And until all of that is all fixed and all the kinks are taken out or cleaned up, you're not going to really have that true mass adoption or institutional adoption, because that's part of a risk, right? But you usually have, like in any new market, you usually have the individuals who come in who are willing to take that risk and test the platform out. And so those are the guys I think are using it. And, I think that's going to be a interesting market to explore in the coming years, to be honest. Like, I think right now it's like what DeFi has done this year is phenomenal. It's really exciting. I just can't wait to see exactly, how much more it matures.
For sure. I tend to agree with you in that particular perspective. I'm very excited about the idea of decentralized finance. Obviously, the runaway price increases are always something that sort of gives pause, because it has the ability to affect a lot of retail investors whenever the inevitable sort of exuberance begins to die down and it starts to come back down to earth. But ultimately, I think the theoretical nature of decentralized finance, I'm very, very excited to see how that is going to shake out, especially as it evolves and goes through some of its growing pains with sort of as you're talking. With that, where do you see the next sort of value add service for prime brokers like yourselves? I think I saw an announcement maybe a couple months ago that you were getting into the separately managed account business. Is that something that you think there's huge opportunity for? I personally think that there's a huge opportunity for SMAs within this particular market. So is that an area that that obviously was validated enough for the company to make a push in there? And have they seen that since they've rolled it out? And is there an additional area beyond that maybe I just haven't seen, or you think might be the next great value added service for prime brokers like you guys?
Yeah. So, I'll clarify one thing, right? Like, I don't think, and I think most people agree, is that, we're still in the early stages for prime brokerage is still in the early stages. And I don't think there is a single true prime brokerage that covers everything like you would have from the traditional sense, right? Because if you consider prime services, that's cap intro, that is capital efficiency, portfolio compression, and a whole variety of different services, right? And on our end right now, we are adding in other services to get to that point. First piece was really capital efficiency, clearing, and trade execution. And then the second piece that we saw that from natural client demand was the SMA piece. And so with that, what we did start seeing is we started seeing more registered investment advisors, even investors asking, I need a structure to get involved so that my clients' funds or my funds can be segregated, but I still want to achieve that same performance of me, investing into a fund. Because, as you probably know, it's when you invest in a fund, a pool of funds, you don't really see what activity is happening until the end of the month or quarterly reports, depending on what's reported. And what we see is like investment advisors and investors that are investing in funds kind of want to have their funds, naturally move into a segregated pool so that they get full visibility, but still experience that same performance. And so and that's the reason why we developed that. Like, we do have certain large SMA managers managing, I confidently say it's the top 1% funds in crypto, using our SMA solution, which is great, because the reason why they came in was they were like, because the amount of money that they have, they don't want to move funds to a third party. They wanted to make sure that they had control and see what activity was going on. And so what we did was we created this SMA solution where we handle the full banking, the full onboarding, and so forth, as if that investor is the client of SFOX, and then they can invite a manager to trade on their behalf on the account. So that manager has pure trading access, but then the investor could have withdrawal access, control access, and so forth. So that was very interesting, and we're starting to see more and more interest on that. What we're hoping is that from the RA and wealth management side, that's going to grow even further. What we do see is that our conversations with these groups continues to grow, but there is a sticking point, which is the clarity of regulation. Because if you're an RIA or you're a wealth manager, there are certain compliance regulations that you have to meet. And unfortunately, on the U.S. side, there isn't too much clarity on that, right? So from a client standpoint, their job is to cover their ass, right? And they're not going to take a risk that they're unfamiliar with. And that's why you kind of see that the adoption of, Grayscale's GBTC and their EBTC investment products have grown, because compliance can easily approve that. They're like, look, like it's traded on it's traded on the exchange. It has an ISIN. We can approve that. You can give it to your exposure. But to get direct exposure for the underlying of Bitcoin and crypto, that's something that's still difficult. But we're hoping with at least getting that SMA infrastructure, the first leg, and then hoping that the regulatory side will get cleared up where compliance feels more comfortable with it.
Yeah, I think SMAs are incredibly, I think they're a low friction product that can help bring the additional waves of investors into this particular space, because even the people that don't want to go full bore into digital assets, maybe they just want to dip their toes in Bitcoin, just get a feel to see what everyone is talking about, what all the buzz is talking about, or Ethereum or Litecoin or anything like that. SMAs are a very low risk way to do that if you feel like you have a value add financial advisor or certified financial planner or wealth manager. Obviously, Tyrone Ross, I had him on the podcast. He comes to top of the mind as someone to where you would have confidence in doing that. But also, even for funds like myself and other funds as well, that's a very, not frictionless, but a lower friction point to be able to onboard some clients that are looking to get exposure to the space, but might not necessarily want to deal with the inevitable hoops that you have to jump whenever you onboard with a hedge fund. So I'm incredibly bullish the SMA space, and I'll be very, very curious to see how that progresses with SFOX, as well as like to see the overall palette for it within digital asset ecosystem as well.
Yeah, no, and I think you brought up a lot of good points, Chris, because like one of the biggest things is it's a lot of these investors want to get in, but they are so afraid of how the process works, right? Like, how do I trade, or how do I hold my crypto? How do I manage it, and so forth? And in fact, like, they just actually want other people to manage it on their behalf, right? So if they worked with you guys like Valendero, who is fully aware of how crypto works, how to trade efficiently, and so forth, then that makes them feel more comfortable, because at the end of the day, honestly, like, all these guys really just want that exposure. They see it across all across media and everything. And the thing that blocks them is that they're afraid of, because the media likes to embellish and market, the complications of being hacked or how to manage it, that they're too afraid. But with an SMA solution, they realize that, look, like, you're telling me I could get direct exposure, have control, but then have other people, professionals, manage it who have experience in crypto, managing on my behalf. By all means, let me try to do that. And I think that's been like a very interesting story that's been picking up.
Yeah, for sure. I mean, even just explaining how you've crossed all the T's and dotted all the I's can be very daunting, and you see investors' eyes starting to get very big. It's like, don't worry, I've got this, and we're a custodian here. This is our bank. We've got this. We've got that. You start to see they're looking at you very, very wide-eyed, and you're explaining to them why you're, the proper precautions that you have to take within this particular market. I think, again, just saying SMA, everyone kind of gets that and understands it conceptually, especially if they've already got a portfolio, they've already got a financial advisor. This is just one additional piece that they're going to bolt onto their existing portfolio and add a percentage to. So I think that has the ability to potentially be one of the easier way that you can juice, or that the narrative that has been going around digital assets for the past, since 2018, that institutions are coming, or more institutional capital is coming, is that can easily come from the financial advisory sector, where Tyrone Ross quoted something on the podcast. It's like, I don't know the number, but I think he used the word trillion in it, or like very high billion. So just because it's not a CalPERS or something like that moving around billions upon billions of dollars, little accounts add up to a lot if it all comes in droves. So I think that's something that is very, very interesting, like I said before, to kind of see how it shakes out over the future.
Yeah, no, it's a good point. Like, I actually did like some research on the IRA market. I forget the exact number, but yeah, you're right. Like, it is in the trillions. It's an insanely amount. And from the, what you see in even in the traditional markets, the SMA is actually picking up on that end too. Like that trend of SMA adoption, just on the traditional sense, it's constantly growing. And what people don't realize is like, yeah, like, having a small percentage of that get into the crypto market, that is an institutional line that comes in and changes the game. So that's going to be very, very interesting. I think if people haven't seen it already, or I don't know if you read it, like Bitwise did a survey of, I think it was like over 415 or 450 registered investment advisors. I think was it like 76% of them have received 76% of those registered investment advisors have received inquiries from clients about crypto, wondering how to invest and so forth. I think like 69% are exploring of trying how to figure out how to allocate into crypto. So there's clearly that conversation happening in that space. But a lot of it that I think that survey mentioned was that clarification of compliance. Like, are they allowed to, like, how can they facilitate it or not? Because there is no clarity on that yet.
I mentioned it a couple times, and it's I don't like legal or anything like that. And
No one does.
honestly, the way my mind works, the moment I start reading legalese, I instantly start getting tired and I just check out. So it's very difficult. But with that being said, you mentioned a couple times, and this is a very, very important part of this particular market, not only for existing players, but also people, a lot of the ones that we're talking about, more traditional investors that are talking with their financial advisors or RIAs about getting exposure to the space, need to understand, and it's a big question in terms not just of compliance, but also regulatory guidance as well. So can you just tell me, some of the things that SFOX has done to get the blessing of the local regulatory bodies, or play within the rules, the existing rule set of the regulatory bodies? And also, how does that affect the coin offerings that you guys have on SFOX? Because there's a laundry list, and there's a different token that is catching people's ear that I'm sure retail investors are asking their client or their financial advisors about day after day.
Yeah, no, that's a good thing. So what we do is, I mean, our number one thing for like any U.S. company is to be as compliant as possible, right? And compliance is a huge focus on our end, and we actually spend so much money on fees for that. What we do is, so we are FinCEN registered on a federal level, and then what we do is we also work state by state. So we have state by state approvals. We take our model, work with each of the state regulators on the MTL side, speaking with them and ensuring that our model makes sense, and do we have approval to operate. Now, there are some states that we don't, we operate in not all 50 states, but we operate in, I think it's more than 56% of the crypto trading population. And in that sense, like, we make sure that we have the approvals from each of those guys and so forth. Now, going into the coins. So that's a regulatory hurdle, man, because like what we list and offer is stuff that we have gotten legal approval from. We'll work with our legal counsel and outside counsel to make sure that, hey, is this a security or not? And if it is a security, we are currently looking into how can we, what licenses are required, and what do we need in order to offer those. for now, from the coins that we offer, from Bitcoin, Ether, Litecoin, and so forth, those have been approved where, it's not considered a security. It falls under license that we have, that it's been approved to use. So that's kind of where we stand right now. I mean, any new coin that we look at that we want to offer, we make sure that we're speaking with legal counsel, both in and outside, ensuring that, it's following, it falls under everything that we have in terms of our licenses.
It makes sense, and obviously that's another piece of that prime brokerage sort of element that we've been talking about pretty much this entire podcast, is making sure that all these the T's are crossed, the I's are dotted, because these are all questions that, or boxes that need to be ticked before you enter the space, or even for individuals like myself, whenever we're onboarding new investors, that they're asking, especially if they're in the know. Some people that maybe are a little bit more hyped around the news cycle, they're just excited to be able to get exposure in the space. And those are typically high net worth individuals that, from a variety of different backgrounds, typically from a startup background. So their risk tolerance is a little bit higher. But as we sort of cross this chasm to the average individual with a portfolio that they're just looking to diversify and potentially get outsized expected returns for the next 5 to 10 to 20 years, especially whenever you look at the equity markets or any of these other really hot markets, probably from a historical valuation perspective, digital assets become very, very attractive as well. But regulatory is one of those things that you have to have an understanding about before you jump in. So that all makes sense 100%. Before we wrap up the podcast, I always sort of just ask people just their general views of where they think the market might be going in the next 2 to 3 years. Before I was saying future, but then I realized that this market is incredibly fast moving. So future 5 years is going to look entirely different than future in 2 years or 3 years. So in the next 3 years, from your particular perspective in the area or the niche of the market that you work in, where do you see the next big innovations or the next potential big game changers happening for the market?
Yeah, sure. So, like this is going to go back to like the conversation about how people are waiting for these institutions coming in. What I think and what we're kind of seeing is that, and it's coming out in the media as well, is that the institutions that are coming in, that I think is going to lead to this change in adoption, is really going to be driven by, I think, the individual and retail market, not the bigger banks, but the companies that are focusing on B2C, businesses to customers, right? Because you have the payment companies. Think about with the announcement with PayPal coming out, right? You have Square. Those guys have access to millions and millions of individuals. And if you look at Square's numbers, crypto Bitcoin trading revenue, actually, I think it represents more than 50% of their entire revenue for the Cash App. And now you have PayPal coming in, and then there's all these new challenger banks, neo banks that are coming in that are going to start offering crypto, and that's going to lead to a full adoption on the individual side. And to be honest, once that happens, the bigger financial institutions, the banks who are sitting on the sidelines waiting, they're not going to have a choice but to get in. I think you're gonna see that in the next couple of years, right? Outside of that, stable coins, man. Like, I think that's DeFi. So just going back to DeFi and stable coins, those are the two things I think are going to be those are going to be really interesting. Most people may not realize this, but in Southeast Asia, stable coins has been very, very popular, and merchants are actively using it. Frankly, because it does what it needs to be done, right? Like Bitcoin was created in order to transfer funds from peer-to-peer very quickly. The problem was that Bitcoin had that volatility. What stablecoin is solving and doing today is solving that exact problem. You can transfer very quickly and simply, and it maintains its value, and it's very easily accessible. And then DeFi space, I think I'd say that bigger financial institutions, traditional ones, need to worry because, dude, that's what DeFi is doing. You're basically being able to be your own bank, access loans, we could get yields, and all have that control independently without having a central counterparty. I think that is going to be a very interesting space where you're going to start seeing people rely less on. Obviously, there's always going to be that relying on banks, and I'm not going to say they're going to be completely disrupted, but you're going to start seeing a slow change, especially in the less developed markets, right? Looking in countries where you don't normally have access to banking infrastructure, that is something I see is going to be a very interesting adoption and growth in that area.
I feel like I say this all the time with podcasts, and maybe I just don't disagree with my guests nearly enough, but I totally agree with you. And again, I think I was talking about it on another podcast that I did earlier this week, talking about stable coins. And stable coins, again, we're sort of blessed because we live here within the US. We've got the world's reserve currency, stable prices for the most part, unless you're living in San Francisco or New York and looking to buy a home. But we've got this amazing ability that not a lot of the rest of the world has experienced. And I didn't fully realize it until I was talking to other people in other parts of the world, in Asia, in New Zealand, in Latin America, and they're using this already, maybe not even for day-to-day purchases, but just to have some of their rainy day fund within these stable coins. So it's like if you are living in Argentina or you're living in Vietnam, and specifically this year, given what everyone assumes, or at least some macro people believe, will be a dollar swelling event where the dollar will increase in price vis-a-vis other weaker developing currencies. I mean, the Brazilian real, I believe, is down approximately 30% versus the dollar earlier in this year.
Yeah.
So if you're living in those regimes, and all you can simply do is take that out, and if you've got an internet connection and you've got access to some decentralized finance app or some exchange, and you can easily convert your local fiat into a stable coin, whether it be Tether or USDC or Paxos or anything like that, and you're instantly in dollars, you've got a stable store of value and medium exchange that you can use at someplace else. That is a complete game changer that personally I didn't see, obviously, because we live here in the US, but that is one of the things that has really opened my eyes. And I wrote about it in one of the earlier research pieces that I did in partnership with Brave New Coin earlier this year, talking about store of value premise. We did this before sort of shit hit the fan with COVID and Bitcoin came to the limelight. Is I hypothesize that this next wave of growth is going to come from the periphery, not necessarily the center in terms of developed countries, because why would they? But you've got majority of the world's population living in these areas that are not historically within stable fiat regimes, and now you've got this ability to get access to a stable currency. We would gripe here in the crypto American sphere that the dollar's depreciating, but compared to other areas, it's complete night and day and a very stable mechanism to hold your wealth in. So I think that is something that I'm truly, truly interested in seeing. With that being said, I know we're going to wrap up, but my interest is piqued. Do you think that more regulatory scrutiny is going to come to stablecoins, specifically because governments, maybe not the U.S. or even Europe or any of the other larger economies, feel threatened, but some of these other periphery type economies feel threatened, and they're like, hey, we need to get some kind of coalition going here to be able to protect our local fiat regimes, because this is a real threat to our monetary policy?
Yeah, no, that's a good that's a good question, and I think 100% there is going to be, right. And I think this is that regulation actually started even happening prior to stable coins, because if you think about it, the way the banking system works, right, is that normally the central bank would have a view by working with your local banks, right, and because every transaction happens through either ACH, like let's talk about the US. If the bank happens through ACH or through a wire transfer, the central bank has a full view on it because that activity is occurring. But then here's what happened recently. And now when I say recently in the last 10 years, is that parties like Venmo, PayPal, and so forth came in, and these services where they're not actually using the banking rails to transfer funds. It's actually all happening on their own private networks, right? So you could send me a PayPal, over PayPal, you could send me $25, right? The central banks won't see that transaction unless I make that withdrawal, right? Because all that transaction is happening within the private network. And so I think what you're kind of seeing on the central bank's concern is that, they are, they're missing that activity. And now they're actually losing that control. And that's kind of part of the reason why you're seeing more of these conversations of central banks trying to create their own stable coins, because they want to have that view. And if they don't get involved in this, then they're going to realize that the PayPals or the Venmos and other companies out there are going to disrupt it, and they're no longer going to have access. So, you're going to see these regulations. I think you're going to see these regulations getting more involved, because at the end of the day, if the central bank doesn't have any relationship to it, then what are they going to do? And only way for them to do that is by, unfortunately, putting either creating their own coin and then setting up regulations where only they can operate it. So I think like it's inevitable to see.
Super. I think I don't know how it's how it's all going to pan out. I think there might be, well, I guess if there's some form of synchronized coalition, there could be some, more punitive measures, but I think we're a little bit of ways away from that, given regulatory bodies don't even know how to deal with the existing currencies that we have or digital assets that they still feel falls within the hash marks or their good graces. So it'll be really interesting to see how that all pans out over the next 12 months, 18 months, 24 months. But regardless, I think we're firmly in alignment saying that DeFi, and we both consider stablecoins a part of that ecosystem, is one of the more interesting innovations that could potentially be a game changer and or quite disruptive moving forward. So hopefully it'll be an additional value-added service that SFOX could layer on in the future to continue to add more and more value to the clients.
I think it'd be really cool to see if for all these all these stablecoin issuance right now are independent, right? So if there's like a self-regulated body that ends up coming in, where like you said, like a coalition that comes in and starts as all the main participants come in and they start doing self-regulation, that could be really, really interesting to see in coming years.
Yeah, I obviously I hope that doesn't happen, because that's not going to be, they're not going to be there to pat stablecoins on the back. That's for sure. But hopefully we don't see that, or we see some more thoughtful process towards regulating stablecoins or anything like that. But with that, we'll wrap up the podcast. Daniel, I want to thank you again for taking time out of your busy schedule to be able to jump on and talk about all the nitty gritty in terms of liquidity, early days, and then unfortunately needing to talk about regulatory and then some more of the legal stuff. But I really do appreciate you taking time out of your schedule to hop on and have a chat with us.
I had a blast being on. Thanks for having me.
All right, everyone. Thank you so much. I will see you next time on the Crypto and Muay Thai podcast. Stay safe. I will talk to you soon. Bye.